Hello and welcome. In this session, we're going to look at a couple of questions from the practice assessment 2 for the business tax. I have received some email from some students and they're asking to explain this task 5 and task 8. So I'm going to explain this two questions. So let's start. So the first thing we're going to look at for task 5 for 6 marks, and this question is relevant to the relief. So let's have a look. First, we're going to read the question. It says this task is about chargeable gain and allowable losses for the company. So Garrison Limited sold a old warehouse for $864,000 and on 10 October 2021, realizing gain $280,200. So that's the gain by selling this warehouse. Garrison Limited replaced the warehouse with a smaller property acquired on 31st of December 2021. This property cost $790. So few things very important to understand for the rollover relief. Now before I start the question, I like to go through quickly with the condition for the rollover relief. So I want to open the reference material that is available on the book, and also you can see this one during the exam time, so it will be on your exam template. So you're going to see on the exam window this one as well. So that's the reference material you can see here, and I have opened from the book, and of course we're going to go through the condition. So on the relief section, we can see here it says replacement of business asset rollover relief. Now on the condition, we can see here it says it's available to individual and the companies both, but for the exam it will be only examinable for the companies. So there will be no rollover relief for the individual or for the sole trader or for the partnership in the exam. So few conditions. The first one, qualifying asset, original and replacement, must be used in a trade and be land building or fixed plant and machinery. So must be used in the trade and be land and building or fixed plant and machinery. That's the first condition. Number 2, qualifying time period. That's very important. Replacement asset must be purchased between 1 year before and 3 years after the sale of the original asset. So the day we're going to sell the original asset, from that day 1 year before and 3 years after. So within this time we have to buy the new asset. Partial reinvestment, if we do not invest the full money, for example, if we sell the old asset for £10,000 and if we only invest £5,000, then there will be some immediate gain that will be taxable. Say if only some of the sales proceed reinvested, then the gain taxable is lower of the full gain and the proceed not reinvested. So the gain taxable is the lower of the full gain and the proceed not reinvested. So I'm going to explain a little bit in detail the meaning of that, but for the time being, now we know the condition. We'll go back to the question now and I'll show you a little bit in detail from there. Alright, so our next thing, we're going back to the question and we can see here okay. So it says here, Garrison sold a warehouse for $864. So this is the selling price, the proceed value. So you're going to say the proceed was $864,000 and make a gain $280,000. So the gain $280,000. Now we can see easily, if we find the difference between these two, the proceed and the gain, that means the difference is the base cost for the old warehouse. Even though you don't need it, but for the time being we understand, if we minus the gain or the profit from the selling price, the difference we'll have, that will be the cost. So we say, okay, we understand that. The next one we have here, it says Garrison Limited replaced the warehouse with a smaller property. That is the new property they buy, and when 31st of December 2021. That's very important. The reason it is important, that has to be fulfilled the condition. What is the condition? Within 1 year from the date of the sale before, or within 3 years after. So we have sold 10th of October 2021 and we buy the new asset 31st of December. So that means like it is less than 3 years. So on the same year, after just 2 months, we buy the asset. So we have no problem for the condition. It is fulfilled the condition, because from 10th of October 2021, I can go back 1 year and we can go forward 3 years. So we have fulfilled the condition. There is no problem for that at all. So we are qualified for the rollover relief, because this asset is used for the business, and the day we sold, we are buying within 2 months after we selling our old warehouse. So we are qualified for the rollover relief. Now the next question is, how much gain I need to pay the tax on right now, because we need to find it out how much money is not reinvested. So this property costs 790. Now you can easily see here, we have sold for 864 and we buy the new one for 790. That means how much I received by selling the old warehouse. I'm not reinvesting all this money. So if I don't reinvest all this money, if I have some money with me, on this amount I have to pay the tax immediately. So that will be my realized gain, and this gain cannot be rolled over. This gain cannot be deferred for the future. So here, if we try to find the difference, so 864 minus 790, that will tell me how much money I have with me. So 864 minus 790, that gives me 74,000. So this 74,000 I did not reinvest. So not reinvest. And if this is the case, remember that I have to pay the tax immediately. That's the realized gain. On this gain I have to pay the tax. This gain will not be rolled over. So that's my first thing. So let's have a look. What is the requirement? It's a calculate the gain chargeable on Garrison Limited if a claim for the rollover relief is made. Even after claiming the rollover relief, how much will be the chargeable gain? And of course, as we said, it will be 74,000 that is not reinvested. So this 74,000 will be the gain chargeable. Why? Because I didn't reinvest it and it will not be rolled over. The next question here is calculate the amount of rollover relief claim. So how much will be rolled over? How much money will be deferred, the gain? So total gain was 280,000, and from 280,000, 74 I'm going to pay right now, the capital gain or chargeable gain. So that is 74, that will be immediate chargeable. So if I minus 74,000, so the difference between 200 minus 74,000, and that gives me 206 200. So this is the money, is a rollover. Try to understand. Total gain was 280,200, and out of 274 I'm paying immediately the tax because I didn't reinvest this money, and rest of the balance, this 206,200, will be rollover. Rollover means I'm going to pay the tax later on, not right now. So I'll say calculate the amount of rollover relief claim. That will be 206 and 200. And finally, the last question is asking calculate the base cost of the new warehouse. Now this one is a little bit important to understand. Even though the base cost for the new property. The original cost is 790, but we're not going to follow 790. Remember that, because out of 790 we claim some rollover relief, and remember that it will be always the base cost will be reduced by the money we have claimed for the rollover. Because in future, if I sell this asset, for example, this asset 790 I'm buying now, in future if I sell it for 800,000, then my gain will be only 10,000. So what will happen? HMRC or the tax authority, they are not getting enough tax from me, because in future I have deferred some gain. I never paid the gain on my last asset I sold. For that reason, they will say, no, you cannot do it. You cannot just say gain 10,000. So you have to reduce the base cost. That means even though your cost is 790 for the new asset, as you claimed the rollover relief, you have to reduce your base cost. So how much is the amount, the gain we have rolled over? We have rolled over 206,200. So 206,200, if we minus that from 790, so 790,000 minus 206,200, and that gives me 583,800. So you can see here now if you find the difference between these two, the gain will be a lot of higher than 10,000. And that's why HMRC want to reduce our base cost by the amount we claim the rollover relief. So very simple, we make a gain 280,200 by selling the old warehouse. Out of that 74 I'm paying right now because I didn't reinvest the whole amount. Remember that if I sold for 864, if I invest all the money, for example, if I buy new asset and that is more than 864, then I don't have to pay any tax right now because I invested all the money. Every gain will be, all 200 will be rolled over. But because I didn't invest all the money, the difference I have to pay the tax now. And of course, like any gain I roll over, it will reduce the base cost from the cost of the new asset. So that's how we find the base cost, that is 583,800. So if you try to check the old asset, so remember the old asset cost to us, the old asset selling price was 864 and we have a gain 280. Even the difference here will be 583,800. But we're not going to do that calculation. I'm just showing you it will be the same result, but we always do that. What we'll do, we need to find the cost for the new property and minus how much we claim for the rollover, and that will be now our base cost, and that's it. So this is the first question for A. Now we move to the next section for the B. So let's move on for the B. And for the next section, we have that's true and false question. So let's try to do it. Here it says, when Garrison Limited sell the new warehouse, no indexation allowance will be deductible when calculating the gain. Now, so far we know the companies are allowed to consider the indexation allowance or minus the indexation allowance to reduce the gain so that they can remove the inflation. But they are saying when they're going to sell the new warehouse, they will not be able to claim the indexation. And why is that? Is it true or false? Before we give the answer, we have to remember the indexation is stopped or indexation is closed by the government December 2017. So after December 2017, there is no more indexation allowance for the company. So if we buy any asset after December 17 and if we sell, we're not going to get any indexation allowance for that. So let's have a look when we are buying this asset. So we are buying this asset on December 21. So if we buy an asset December 21 and if we sell it later on, we're not going to get the indexation because the indexation is stopped on December 27. And of course, you can see this information on the reference material as well. So if you look at this one from the book, it says indexation allowance, and here is clearly written it was frozen in December 2017. So indexation can only ever be given for ownership up to December 2017. So very careful with that. So when you have a indexation allowance, remember we can only get up to December 17, not after that for the capital gain purpose. So we need to understand, or we have to remember all of this information. Anyway, now we go back to our question. And here we will say that it is true. The reason it is true, because the asset was buy after December 2017, and when you're going to sell it, we're not gonna get any indexation allowance for that. That's true. The next one, it says Garrison Limited cannot have any further rollover relief on the old warehouse even if it makes additional investments in qualifying asset, because the qualifying investment for rollover relief has to be into single asset. Remember that this one is not the condition. If you remember from the reference material, we have seen the condition, and the condition clearly says like the asset has to be used in the business, and we have to sold it for 1 year before and 3 years after from the day we sell the whole asset. This is the condition we have. There is no condition it has to be a single asset, it has to be a group of asset. So it is not the condition. So we'll say no, it's not true. Even if it is not a single asset, they will be entitled to claim rollover relief. The final one we have here is says if Garrison Limited had purchased a large warehouse for 1 million in September 2020, the full gain to 80 on the old warehouse could have been rolled over. Now this one is a look like true, because if you look at the question, it says we sell this asset for 864, but we have reinvested 790. So as I said before, if we invest all this money, 864, all investment, then we don't have to pay any gain. All the gain will be rolled over, that is 200. And they are saying, like, for example, if we buy the new property that is not 790, if it is 1 million, then all the gain will be rolled over. And of course it's look like, oh, I sold for 864, and if I reinvest 1 million, then of course like I'm reinvesting more than I sold, so all the gains should be rolled over. But the answer is like the condition is fulfilled. Here they are saying September. If you look at the date, it says in September 2020. So if we buy the new asset, not December, in September 2020, so what will happen? So we sold the asset October 2021. So from that day I can go back 1 year and 3 years after. Now here they are saying September 2020. September 2020 means is less than a year. So you can see here more than a year. So if you have a look, from 10th of October 2021, I can go maximum 9th of October 2020. So maximum 9 October 2020. That is my 1 year before. But if it is September 2020, then it is more than 1 year. And if it is more than 1 year, I will not be able to claim the rollover relief because it doesn't meet the condition. So you have to be very careful when you read this question. It's a look like it is true, but actually it is not true. It is false because it is more than a year. So it's false. And that's our question number 5. The next question you're going to look at task 8 for 15 marks. That will be a little bit long because 15 marks question. And I have received some email and the students are asking like they don't understand this calculation very well. So I try to explain in detail so that you understand. And also like there are some tricky part here. You need to understand that as well. How does it work? and sometimes the question itself could be a little bit tricky to understand, so you need to be a little bit careful when you answer the question. Sometimes you need to know from the practice assessment what we have done, and we follow that. So let's have a look at this question. This task is about the administrative requirement for UK tax law. This task contains part A to F. Ryan has a plumbing business and has prepared self-assessment tax return for several years. So self-assessment tax return means he's a self-employed or sole trader. He pay all of his tax by self-assessment, and his income tax and class 4 national insurance liability, each tax year is follows. So we have income tax and the class 4 NI. They didn't split it because we have to pay at the same time, so the total bill actually work together, so really don't have to worry like how much is the income tax and how much is the class 4 national insurance, because we pay together. So before you start, let me explain how does it work when you are self-employed. Normally the deadline for the tax return is 31st of January if we do online, and if we do by the paper form, this is 31st of October, 30th of October. So here we are thinking like they do the online, so they didn't mention anything, but we have to assume Ryan do self-assessment and submit through online. That is deadline 31st of January, because we can see the date here, July and January. Now for example, if we are in tax year 2020 and 21, and our tax year is 6th April 20 to 5th April 21, so that's the tax year for 2021. For this tax year, if someone is self-employed, he is liable to submit the tax return through online by 31st of January 2022. So you can understand, for the tax year 2021 we need to submit 31st of January 2022. Now when we submit this tax return, how we calculate? Now for example, it is possible someone is the first tax return submitting, or someone doing for many years. So when you have a self-employment calculation, or when you have a sole trader calculation, you have to be careful because few things are involved here. The first thing involved here is we need to pay the tax, the full tax. So full tax, for example, for 2021 my tax calculation is 1000, for example. So my tax is 1000 and the class 4 NI together is 1000. So I need to pay this 1000 on 31st of January 2022. On that we have to pay this full amount. The next thing is like I have to pay something called payment on account in advance. So we called it POA, payment on account. Payment on account we pay twice. First we pay on the same date, that is 31st of January 22, and we pay 31st of July. 31st of July after 6 months 22. And what is the payment of account? Payment of account means based on my current liability, how much is the current year tax, I need to pay half of them advance in January and half of them in July. Even though in real life, if you don't like to pay in advance, if you think next year your income will not be same, you can remove it, but we are learning the rules, so for the exam purpose we'll follow that. So here we need to see how much is the tax liability for this year, that is 1000. So if I make it half, it will be 500. So 500 I need to pay 31st of January, another 500 I need to pay 31st of July. So we understand in 31st of January I have to pay the full amount of tax and also one payment of account. So I'm paying here 1000 is the tax plus 500 is the payment on account. So I have to pay 1500 on 31st of January, not 1000. Tax plus half of the tax. And another 500 I have to pay on 31st of July. This is the payment of account. But remember that if there is any payment of account that you already paid before, for example, on the last year any POA, payment of account, then I have to minus it from here. If I already paid something in advance, I'm not going to pay it again. Okay, now let's have a look at our question. It says 1920. So the tax year 1920 means 6th of April 19 to 5th of April 20, and that was 900. So this one I supposed to pay on 31st of January 21. I have to pay all this amount. Now before that, it could be the first year. There is no information before, and we don't know like is there any payment of account he paid or not. But before 1920 there is no more year, and the question didn't tell anything to us, so we understand there is no calculation before that. So we will estimate all the 900 paid on that day. So we say 900 paid on that day, on 31st of January 2021. And on 31st of July 21, of course, this is our first payment of account. And if we paid all this money, because we don't have anything from the last year that we are guessing, so our first 31st of July 21, it will be 0. So there is no payment for the 31st of July 21. The next one is 31st of January 2022. That for this year 2020 and 21. So here for 2021 represent 6th of April 20 to 5th of April 21, and you have to pay 31st of January 22. And here I have to pay the same thing, the full tax, and if there is any payment of account, I need to pay that. So here I'm looking at 1200 is my tax. My full tax is 1200, and this 1200 I'm going to split into two payment of account. One is 600, another one is 600. So first 600 will be paid on 31st of January. Together with that, another 600 will be 31st of July 22. So on 31st of January I have to pay 1200 plus 600, that will be 1800. So I'll say 1800 for this one. On 31st of July I need to pay this one, so that will be 600. So I already paid both 1200 in advance. Now when I'm in the next year, that is 21-22, I have to pay on 31st of January 23. And when I'm here, what I have to do, I need to look at how much I will pay. So 2000 I will pay anyway. So that's my tax. 2000 I need to pay the full amount, full tax. Then I need to pay payment of account, half of the tax. This is 1000. And another 1000 I will pay 31st of July 2023. And if there is any payment of account, I already paid. So if you remember the last year, we already paid. Here we paid 600 extra, and here we paid 600. So 1200 I already paid during the year in advance. So I need to minus 1200 from here. So you do 2000 plus 1000, that's 3000, and minus 1200, that's 1800. So this 1800 I need to pay on 31st of January 2023. Now only the thing here is confusing, the first one little bit, because it's 0, and of course like you might thinking like why I'm not paying the payment of account. The reason only I can see here because they didn't give us any information before 1920, and for that reason we are not paying any payment of account here. Alright, let's move to the next one. The next one we have here, okay, so Ryan has come into the office on 1st February 2022. So 1st February 2022, and is concerned that he has been unable to find his records for the tax year 2013 and 14, 15, 16, and 16-17. So what happened if you lost the record? So I want to open the reference material once again before we start this question. So you can see here on the reference material the record retention. It will be on your exam as well, but if you know from before, it will be easier for you to answer the question. But if you really forget, if you don't remember, if you want to double check, you can always open during your exam to quickly have a look. So for the sole trader or partnership, we have to keep the record for 5 years from the filing date, and if we didn't keep, or for any reason we lost it, then there will be a penalty is 3,000, and 3,000 for each year, not for the 5 years. Remember that, for each tax year. For example, if you lost for the tax year 16-17 or 17-18 or 18-19, so for each year the penalty will be 3,000. But for the company it is 6 years. Remember that, do not mix it up. For the sole trader is 5 years, for the company it is 6 years. Now if it is 6 years over, then HMRC cannot come and check your record, so you don't have to keep the record after 5 years. For the sole trader, you can throw it, you can destroy it, they cannot come and ask unless you need it. So we need to know that. So now we need to go back to our question so that we can have a look. So you know 5 years and 3,000 is the penalty. So if you go back and if we have a look, Ryan has come into the office 1st of February 2022 and is concerned that he has been unable to find his record for the tax year 2013, 14, 15, 16, and 17. Now when he come 1st February, so you need to see from that year, if I go back 5 years, which one I have to really keep by law. So we can see 13, 14, from 13, 14, from 14th April, if I count 5 years, so 15, 16, 17, 18, 19. So if I keep up to 19, I'm fine. So up to 19, I'm fine. Here up to 2020, I'm fine. Here up to 2021, I'm fine. But only here I have to keep up to 2022 April, and he come to the office on February. That means only this one is still few months left. Other than this 4, we are clear. Even if we don't find it, if you lost it, there is no problem for that because it's more than 5 years. So only this one I have to see if I don't find it, and obviously if I lost the record, HMRC can give me the penalty. So let's have a look. It's a record must be kept for 5 years because he's a sole trader from, remember that, not end of the tax year. The filing deadline for the tax year is filing deadline. So your tax year is ended, for example, on 31st of 5th of April, but it's not 5th of April, so it is actually the filing deadline. That means we have to see, for example, if our tax year for 13-14 is 6th of April 13 to 5th of April 14. So this is my tax year, and my filing deadline is 31st of January 15. So for 13-14, we have to file on 31st of January 15. That's my deadline. From here I have to give 5 years. Remember that, not from the 5th of April where the tax year ended. Now from the filing deadline. So for 2016-17, the filing deadline was 31st of January 18. And from 18 I have to keep 5 years. So that means you have to keep January 19, January 20, then January 21, January 22, and January 23. So you have to keep till January 2023 to complete the 5 years. Other 4 is okay. Only this one I have to keep 5 years from the filing deadline. Alright, the next one we have here, Ryan could face a penalty up to £3,000. You already seen this one on the reference material for each of the tax year. Yeah, that's true. This penalty could apply to Which one? We know only the tax year 16, 17 only, because this is the one we still have to keep. Other 13, 14, 14, 15, 15, 16, we are okay with that. All right, the next one we have here, that is, it says delimited prepare accounts to 30 June 2021 and has a liability 18,980. Identify which one of the following statements are true. Delimited must file a return by 5th April. Remember that the filing return is quite straightforward. So from that day when the accounts is ended, so from 30 June 2021 we have 12 months. Simple as this. Within this 12 month you have to submit the return to HMRC. So from that day, remember that it's not the company house, it's with the HMRC. Return means HMRC. So tax return we need to submit to HMRC within 12 months. The day my accounting period ended, from that day I have 12 months. So we can say that will be June 22. So 30 June 22. That's very simple. The next one we have here, C Limited has a tax liability 8,900 for the year ended 30 September 2021. Tax return is filed and the tax is paid 17 May 2023. So if we have a year end 30 of September, then we need to submit the return. We need to submit the return by 30 September 2022. But we submit on May 23. So from here to here, how many months after we submitted? So we say October, November, December, January, February, March, April, May. So more than 6 months. 6 months and 17 days. So now the question is, how much will be the penalty? Now the penalty, we have a fixed penalty and we have some penalty on the tax as well. So before we do this question, let's quickly look our reference material. Okay, it says penalty for late filing. Now that's for the sole trader and that's for the company. So here you can see the fixed penalty, even if I'm late 1 day, the fixed penalty is £100. And after 3 months is 100. So if I'm late for more than 3 months or 4 months or 5 months, the penalty will be £200. That's the fixed. 100 even for 1 day. And after 3 months is another 100, so 200 here. And if it is more than 6 months, then 10% of the unpaid tax. If it is 12 months, 10% of the unpaid tax again. So we need to add it all of this thing. So first we can see we are late here 6 months and 17 days. That means more than 6 months, but less than 12 months. So we'll say we need to pay for 1 day late 100. For 3 months late you pay another 100. So 200 you have to pay fixed penalty. And as you are late, you need to still pay 10% of the unpaid tax because you are late more than 6 months. So let's go back and look at the question. So we are saying here you need to pay £200, 100 for 1 day late, even less than 3 months is another 100. So fixed penalty is 200 and 10% because of more than 6 months. So 8,900 multiply 10% because I'm late more than 6 months, that's 890. That will be the tax penalty on tax, 890. I think that's it. Okay, let's move to the next one. The next one we have here, H Limited started trading on 1st June 2021, preparing its first set of account to 31st December 2021. So June to December. Okay, so it's 7 months from 1st of June. Complete the following sentence. When completing your date, you must enter the full. So Henderson must notify is chargeable to corporation tax by. Now it's very interesting. You have to remember it is a limited company or it is a sole trader. If it is a limited company or sole trader, doesn't matter. You can always open the reference material and you can always see it. So let me show you. So we have here so note of notify. So we have notify chargeability, you can see here. So notify of chargeability. If you are a sole trader, then you have to notify 5th October following the end of the tax year. If we are a company, then within 3 months of starting to trade, within 3 months starting of the trade. So let's have a look now. So when did we start our business? From that day, within 3 months, we have to tell the HMRC. So H must notify that chargeable to corporation tax by June, July, August, within 3 months. So June, July, August, so end of the August. So let's have a look. 31st of August. 31st of August 2021, within 3 months. You can get a lot of answer from the reference material if you know it is already there. Okay, let's have a look. The next one is identify whether the following statement are true or false. Statement: P Limited has made an error in the tax return which was identified by HMRC. This is a prompt disclosure. Remember that prompt disclosure means identify by the HMRC, and unprompt disclosure means like when you tell the HMRC by yourself. You really don't have to tell yourself. If you tell your agent, like your accountant, can you let the HMRC knows about this error? If you do that, still this is a unprompt error. Unprompt error means like you are telling yourself to HMRC, I had a mistake, I had an error, so I now find it out, so I want to correct it. That will be unprompted. And the prompted means like HMRC doing the investigation and they find there is a mistake or error on your tax return. So obviously if there is a prompt disclosure, or if HMRC find you, they'll give you more penalty. If it is unprompt, that means like you disclose yourself, sometimes the penalty could be 0. So the first one is true because error was made and identified by HMRC, not by the client. Brian is an electrician and has prepared his own accounts and tax return for many years. He started using an accountant on 6th April 2021. The accountant identified an error in Brian 2017 tax return. Brian has given permission for the accountant to tell HMRC about the error. This will be a prompt disclosure. That's not true. That's false. Because the accountant found the error and the Brian giving the permission to the accountant to tell the HMRC. So still Brian is the person who telling the HMRC. It's not HMRC find by themselves. For that reason, it is unprompt, not prompt disclosure. And that's it. Our question number 8, the task 8 for 15 marks. So I hope you understand all of this thing. If you have still any question, feel free to email me, and hope these videos will help for your better understanding. Thank you very much for watching.